Welcome to the Greed Geek Podcast with your host, Jason Fern.
What is up, everybody? Welcome to episode 7 of the Greed Geek Podcast. Today, we're going to talk about startups, fundraising, angel investors, and exits. My guest today is Jacques. He is the CTO and co-founder of Fat Merchant, an Orlando, Florida-based startup in the fintech industry. Fat Merchant was founded in 2014, and it is an Inc. 500 company, meaning it's one of the fastest growing companies in the United States. Jacques, how you doing?
Doing fantastic.
Awesome, man. Hey, tell me about yourself and about how you got started as an entrepreneur.
Yeah, it's basically been in my blood. It's been in the family. I've always, growing up, I saw my parents, working all the time out of their home office. They had a real estate brokerage, and so yeah, I just kind of grew up with, like, when you start your career, you start your own business like that. That was just sort of the philosophy for the family.
You just always knew that was going to happen, huh?
Yeah.
So how did Fat Merchant itself come to be?
I was at the startup before Fat Merchant. We had grown it to a sizable business, and I was just sort of like looking for the next thing. I joined a tech accelerator called Starter Studio, which was Orlando's first tech accelerator. And that's where, I had a different idea, but we ended up, I think we were the first group to merge together. So my team merged with the Fat Merchant team. So we just ended up finishing that accelerator together.
Okay.
And that's how everything got started.
And you guys have been on a kind of a crazy ride since 2014, and you've grown so quickly. So let's talk about kind of how all those things going to be. I know you've taken, 4 rounds of funding ish.
Yep.
So let's talk about that.
Yeah, I mean, it's been fantastic. So we have our original model was, what we wanted to do was not make a percentage off of every sale. We wanted to just give you the direct cost of processing as a business owner. And instead, what we want to do was sell you software for a subscription. So it's just, kind of like Netflix model. We're going to sell you a subscription to, swipe cards, do invoicing, have a little shopping cart, things like that. And then the processing, we're just going to give you the rate that the banks gave us. And no one was doing that at the time. A lot of copycats afterwards, and that's fine. So that was our model that we championed, and we really focused on bringing all those technologies together to add a lot of value in that subscription. More recently, we've gone more with a new side of our business. The direct side is still there, but the part of our business that's growing more rapidly and reminds us a lot of some of the early days as far as the trajectory of that growth. Is our what we call our ISV side. So if you're familiar with like the Stripe model, we also offer an API to the market. But what we do is help software companies become payments companies, right? And monetize payments within this. There's so many great softwares out there for little specific industries. And what we want to do is take all of the heavy lifting of the payments infrastructure, give them a lot of tooling to help them grow the payment side of their business, and then ultimately help them monetize as a source of revenue.
So you're taking on a lot of titans. On one side, you're going against the PayPals and the Visas and the Squares of the world, and the other side you're going against Stripe, which is for as a developer is a very endemic, very powerful thing, like everybody knows. So you're going against both of those.
Yeah, it is an interesting situation to be in. But I think that's part of our value proposition, right? Like, we have a core business that we sell directly to SMBs. So when we, spin up an API for a software company, we can actually explain to them all of the experiences that we've had building our, business. And we have software that's running off of the same API. It's not just some API of like, okay, you guys figure it out. It's like, no, we actually use it this way. And we give you the same API. We actually just expose the same API that we use. So, we feel like that's an advantage.
So I don't mean to turn this into a sales call, but as a developer, and for those who aren't developers, Stripe is very well known in the industry because it's so easy to integrate with. So are you telling me that you're like, for somebody like Flow? I work at Flow Sports, and we sell subscriptions direct to consumers. We have some other things in our application where we do transactions. Are you telling me that, hey, you're an alternative and you may be able to save us a big percentage off what we would otherwise be paying at 2.6% or whatever?
Yeah, it's different, right? So I will say Stripe has locked down. They have a huge, massive team of making all kinds of SDKs and docs. So from the developer experience, like absolutely, they're great and fantastic at that. What we're fantastic, our customer is not necessarily the developer; it's the software company. Right. So for what I would say to a company like yours is, hey, do you want to like increase the valuation of your business and make more revenue off of payments? We'll give you tools to do that. We'll explain how to take your business and make it and basically make it also a payments company and make that a huge revenue source. And that's the difference.
All right, Jacques, we got to talk later about that. Let's set up a call for next week.
Yeah.
Cool. But moving on, we want to talk about, the life cycle of a startup. So I'm interested to understand how your idea went from idea to launching to fundraising to growing. Like, let's talk about that process.
Yeah, absolutely. So first off, I'll say, so people have context. I've built about 4 startups in my career. So a lot of the investing, the angel rounds and things like that. So that's where most of my experience comes from. I have invested in about 10 startups so far. So I have started doing some angel investing, but most of it has been on the other side of the table, right? As the person raising the funds as opposed to being the investor. 2 of those startups did not succeed. 2 of them did succeed, and one really well, which is the current one. Not the other one didn't, but I'm no longer in that one anymore. So the life cycle. So we're talking about the life cycle of a startup and how Fat Merchant sort of.
Yeah, I mean, everybody has ideas. Like almost everybody you talk to be like, "Oh, I have a great startup idea," but most people don't know the actual process of taking that through and what that might look like.
Yeah. So, the thing that catches everybody, and I don't know why this is, most ideas just never get off the ground. And to me, that's the fun part is launching something and seeing people use it. But what I typically see is that people just talk about the idea for, long periods of time. And then, 5 to 10 years later, there's some massive unicorn that implemented their idea and worked their asses off.
Yeah.
Apologize. Am I allowed to curse on your show?
Go for it.
But
so yeah, they're like, it could have been me.
They're like,
right?
I had that idea. I'm like, of course you had that idea, but they worked, day in, day out, for the past 5 years and actually did it. That's the difference. And so for, my advice and what I've seen always much more successful from, folks that other co-founders that I've spoken to, they're the ones that basically went from idea to revenue in the shortest amount of time. Like we're talking like maybe a week, maybe a month, like literally, right? Like, because they're not afraid to put something out there and having people calling their baby ugly. They take that as like a learning, right? Like that's what they're like, that's what I'm looking for. If I were to do another startup today, I would create it in such a way that I could start making money in a week. I could start selling it and then having people tell me why they're not buying it or why it's too expensive or whatever. So
I don't. It's not necessarily money, although probably the best way to know if you have a good idea is if people are actually willing to pay for it, because you'll get a million people telling you it's a great idea, but are they willing to actually take out the wallet and pay for it? Right. That's what really.
Oh, you have to solve a problem. Yeah, you have to start with the problem. I guess you're right. That's probably the first one, is to have the right idea, right? Like there has to be a problem that you're solving, or you can't even get to that first dollar of revenue.
Yeah.
So once you get past that gate of, okay, this is an actual solution to an actual problem, then the next gate is getting that first dollar through the door.
Yeah, there's I'm sure you're familiar with Lean Startup, and so in that book, they talk about what is the minimum thing that you can do to validate that this is a good idea. And one of the things they do in that book is they set up not a fake website, but they don't even build anything. They're like, I'm going to put up a page that says, we're going to do this thing. Put in your email address if you want to be a part of it, right? And so what they've done within a very short period of time then is validate. And if they get no interest in it, they know it's a dud. If they do, they have an email list, right?
Absolutely.
So I think that's what you're really talking about.
That's
right?
fine. Yeah, that's perfectly fine in the ideation stage.
Yeah.
But it's still a pretty big hump to get someone to, pay for it. And that's where the rubber hits the road, because your idea is okay, people want it. That, standing up a website's great. And, if you're getting email addresses, people want that thing. But once they see it, if they're not willing to take money out of their wallet, then the value isn't there for them. Right. So to me, it validates a lot of things to get that first dollar in the door.
Yeah.
Even if you have to make it really cheap to make it worth their while, then that's the price, and you have to build more to get more money. Right.
Yeah. They say do the things that don't scale. When you get out the door, do it the hard way and just see if it's a good idea, and then you can kind of start dumping more into it. So as people do that, they have this baby idea, they launch this baby thing. They're going to have to decide at some point, do I bootstrap this or do I need to go in funding? So to you, what goes into that decision-making process?
I've always bootstrapped for the first 6 months anyway, right? So I don't know if we're talking about like the part beyond it. I don't know how. I guess I'll just, being perfectly transparent, I don't really know how you go out to raise funds for an idea that you have that you haven't built the product and you have no traction. That's not something I have experience with.
Yeah.
It feels like that would be really hard, because the first question I always get when I'm fundraising is like, okay, what's your revenue? Right. And if it's nothing,
I mean, there are a lot of pre-revenue companies out there who do get funding, obviously, but
there are. So it is definitely not, in my experience, but you're right. If you can get a lot of users, if it's like consumer style play, then certainly yes, that is.
There's a lot of ways to generate valuations. Some if anybody's watched Shark Tank, they say, what are your sales, right? But besides sales, there's a way to evaluate, like you said, on number of users or number, different things. But at some point you're going to have to make that decision. Let's say you do build it for 6 months. You're like, okay, we're making a little bit of money. Do we continue down that path and try to grow it kind of organically, kind of the slow way, which frankly is the way that my startup did? I never went out and got funding. I bootstrapped it for a long time before I finally had my exit. But essentially you can pour gasoline on the fire by going after funding, right?
Right. But some people don't like gasoline fires.
So, but if you do want to go down that road, like how do you even start? Who do you talk to? Like,
yeah. So, great. First question is, I think it depends on your personality, right? So, you have to be willing to move at a pace that may not be comfortable for you. And as long as you're willing to commit to that, right? Now you're going to be the steward of other people's money when you're raising funds. Then you can do that, right? You can raise funds. It isn't the only way to go. So I will just say that, right? My third startup we raised 0 funds, and we grew that to over 100 employees. I think they're like 200 now since I've exited personally, and we never took a round of funding. So it isn't the only path, but it is a great way to accelerate something and get it to a point faster. I will say that you don't typically you're gonna want to build some connections, right? It's hard to start completely cold, and that's why I like to I would like to suggest, if you're in that position, that you do pitch competitions, that you join an accelerator, and sometimes I've heard of startups going through multiple accelerators, and in that process you're refining your pitch deck, you're refining your, revenue strategy, your product's getting polished each time, you're developing a network. Because usually like they'll bring in they'll bring in like a bunch of mentors into the accelerator, right? And so each time you go through it, you're building out that network for yourself. And so that's, I think one easy way, that's the way we did it at Fat Merchant. We only went through one accelerator, but that was enough, with alongside the pitch competitions that we were doing to get the traction that we needed from investment interest.
Well, I mean, you had the advantage maybe with Fat Merchant in that you had a successful track record, right? That goes a long way. If they see a history of success, they think that there's a good chance they'll have success again. But that first one can be difficult. So even getting the conversation right can be difficult because there's a stack of applications.
Yeah, I think it's. I think you have to. You have to have the right pitch deck, I think, just to get your foot in the door. So, I highly recommend finding a mentor and having them review like how you've structured the pitch and making sure that business sounds interesting. Because if you can't get the first conversation, then you're just not going to get anywhere.
Yeah, and really nail the elevator pitch. If you can't describe your business in 30 seconds, you got to refine it a little bit more.
And I actually think everyone in the company, like even as you grow, everyone should know that pitch, right? From your operations person to your marketing person. There's so much value in understanding like what problem your business is solving and why you exist for every employee.
So let's talk about once you do take funding, it really changes the dynamic of what the expectations are, because now, like you said earlier, like you are in charge of somebody else's money. They're not giving you this money as a donation. They are expecting a return. So as soon as you take that round of funding, you don't have the option really anymore to grow a lifestyle business, probably, right? There's a destination. And so let's talk about that.
Yeah. So, your first angel round is a little different because it's kind of, any forecast that you put is kind of BS. Like there's not enough history in the business to know. And you're so small that, tripling your business doesn't mean anything if you're only making 20,000 a year in revenue or something like that. Right. Like, so, it's very, very interesting in the early years. I think as you do more later rounds, right, it becomes more sophisticated where it's like, okay, here's been our burn rate in the past. Like, here's how much it costs for us to acquire a customer. You have some more of those metrics. And not to say that you don't want to start even your very first round with some of those metrics, but they're just going to be in flux, like constantly, right, in the early days. But I'm sorry. What?
Yeah, I mean, for those who don't understand even what some of those rounds of funding look like, basically you're getting this money, and the expectation is that you're going to lose money for a certain amount of time because you're spending that capital that you've got, and the idea is you have this certain amount of runway to grow out of, but at some point you're going to run out of. You're either going to become profitable and kind of get lift off, or you're going to have to go back for more funding. But regardless, the end result is to be acquired or to go public, right? I mean, most investors aren't hoping for dividends at some point down the line. Like they want one of those two exits, right?
That's right. Yeah. The investor is there to get, we use the term liquidity, right? They the money, they want to get the money. And so there's only three ways to get liquidity generally, which, as you said, it's to go public. So you can sell your shares out in the open market. It's to get acquired. And then they would just buy all the shares. And then I would say the third is, which actually, we basically experienced, which was a majority investment and recapitalization. And so it was kind of, a little in between, right? Like we weren't necessarily acquired, but we didn't, IPO either. But there was liquidity for all of the early all of the investors of Fat Merchant, basically got 20 times their return in the early rounds with the last investor that we had.
Yeah. So let's shift to like what the different types of investing we talked about. There's friends and family, seed, crowdfunding, Series A. Like,
Yeah.
let's go through what all those look like.
Yeah. So I'll just kind of take you through, right? So sometimes you have what's called a friends and family round, right? It's just friendly. It's just people you know, just to get a little bit of capital to get things up and running. Once you actually have built something, you might be ready to do a seed round, and that's generally where that's the round where outside investors will actually participate, and generally those are going to be what we call angel investors, right? They're investing in pre-revenue companies, so in much of the time. So maybe you've built something, but you're like you maybe just started getting some revenue or haven't yet. Those rounds that an angel investor participates in can be anywhere from like 100,000 to $1 million. Like that's sort of the typical round for an angel investor. So sometimes if you raise a seed round at 200,000, and then now you've got revenue where, but perhaps your burn is still too high and you need to get a little bit more scale. Then you can go on to raise a Series A. And if it's still within that range, like these are not hard numbers by any means, right? But if it's still within the range of like 100,000 to $1 million, it can still be pretty much funded by angel investors. If your Series A goes beyond that, right? If you need more capital to do what you're trying to achieve or to hire the team that you need to build the features to help your product market fit or whatever your strategy is, if you're going up to, let's say, 5 or 10 million, then you're looking at more, I don't know if institutional is in the right word, but you're looking at venture capital, right? Mm-hmm. These are investors that it's not their money, right? So angel investor, just if the etymology of the word is very interesting because it actually came from back in the day. There would be these in theatrical productions that were failing. Wealthy patrons would come in and they would give their own money to the production to help keep it going, right? Even if it wasn't like necessarily viable or able to stand up on its own. And they called those angels. And sort of we sort of co-opted that term to refer to investors that invest their own money into things that aren't necessarily viable and stand on their own. So kind of similar concept. Venture capital they're professional investors, right? And that doesn't mean their size. Like, I mean, it still could be a few people. It could be much larger, but they're not investing their money anymore, which means that they sort of have a process. They have a thesis. We invest in companies like this. They've created a fund. They've raised money from other investors that are like, I don't really want to do angel investing, but I want my money to, go into startups. I'm going to hand it to you guys as the venture capital firm, and I'm going to pay into your fund because I know you guys are the experts and know how to do this, right? So that's where that venture capital comes from. And so at that point, if they're investing in you, again, if it's a Series A or Series B, but it's in between that 1 million to 10 million, range, it's because your business already is doing well, right? Like venture capital is not going to invest generally in a pre-revenue company. Now, you may be burning more money than you're bringing in. That's okay, as long as they see that the top line revenue growth is good. That
revenue, probably not profit.
Probably not profit in many cases. But as long as they see that, they know that they can help you with some more capital, increase that top line growth rate, so that bottom line of where your expenses are, where they can eventually meet.
Yeah, the biggest thing that they're going to be looking for is growth, right? They're looking for that momentum.
And they're also, sorry, go ahead.
You go for it.
No, I was just going to say the other thing that's different is yes, they're looking for growth, right? As opposed to you should already have some market fit by now. But the way they invest is also a little different, right? In the sense that they're giving you a larger amount of money, but they want some more skin in the game. So they're going to ask for board seat. They're going to ask for preferred shares. And that's where
Yeah.
if you're not sophisticated, you can get yourself in a lot of trouble, raising money from these professionals. And they can, I don't mean to, I make it sound like they're the bad guy. They're not, but there are terms in there that if you don't understand what they mean, you're not properly valuing their terms.
Yeah, you have to understand the dynamic changes as a founder, right? You're with some of the smaller rounds, you're still very much in control, but once you go to get those VC kind of rounds, you really have a boss, right?
Yeah. I would more at that point call it a partner than a boss, but that's the goal, right? Like you don't want a boss, at least not yet, right? Like for VC, you want a partner, and that's why they want that board seat, right? Because they want to, because for your partners, just like you would expect within your own business, like there's sort of some minimum cadence that you are all going to meet together and look at all the metrics together, and make decisions.
Yeah.
So the board isn't going to tell you generally, or the VC firm isn't going to tell you how to run your business, but they're going to make suggestions, right? Like this is what we think, or this is what we like, and this is what we don't like, and that's going to, they can have good advice, they can have bad advice. It's not to say that just because they're good investors in businesses doesn't mean that they're good operators of businesses.
Yeah, or know your industry, right?
Yeah, right. Yeah. So, but they can be good partners. They can connect you to other talent that you need. They can help you get other financing if you need a little bit even more capital to kind of meet your initiative. So
yeah. I think that those connections can't be understated. That's a great point. They can really open doors for you and connect you with like-minded people or other businesses that might help your business. So angel funding and crowdfunding. We haven't really talked about crowdfunding yet. Let's talk a little bit about crowdfunding and maybe differentiate the Kickstarters of the world from probably more the regulated crowdfunding, I think is what you said before.
Yeah, absolutely. I mean, the last part I'll just kind of cap off there before we go into crowdfunding is if you go on to Series B, C, and D, that's where you start to move from venture capital into what's called private equity, is what they like to call it. And so private equity, they're doing rounds, 10 million above. And there, I would say it is more like having a boss. Like they're generally buying the majority of your company and having a lot more hands in what you're doing at a business level. But as far as crowdfunding is like an entirely alternative path to fundraising, right? So we talk about bootstrapping, and we're talking about raising money through these investing rounds. But let's say instead of having that angel round in that seed or that Series A, you can take your seed or your Series A and you can just put it on a website, essentially, right? You can go to these crowdfunding sites, and it's different than Kickstarter. So that is a good point that you brought up.
That's what most people think of with crowdfunding.
Yeah. So I love Kickstarter. I participated in that in the very beginning. And one of the things that they tried to do with it, is some of those Kickstarter projects, they would offer you the product and they would say, and also a little piece of the company. And then those got shut down because, basically they were violating, SEC. That's a regulated activity to raise funds. And at the time, there was no guidance for it, right? Like if you were not an accredited investor, sorry, you just can't invest. It's kind of like for your own protection sort of thing. And we can talk later more about, or actually we can talk now about what an accredited investor is. But so anyway, crowdfunding is what's called regulation crowdfunding. So there's crowdfunding, which is like, I really want this mechanical keyboard, so I'm going to put in $100. So I'm going to get that. And then they'll build it. Regulation crowdfunding is when a company raises their round to the public, and for people who aren't accredited investors can participate in that when they normally would not be allowed to, right? So an accredited investor is basically anyone that makes over 200,000 for at least 2 years in income, or has at least $1 million in net worth. There's some nuances to that. Like if you have a spouse, it goes up to 300K, and the net worth, it can't include your house or mortgage. So that has to be sort of set aside from the calculation. But that's basically the definition of accredited investor. The purpose of this is to say it's really risky to do these investments in these startups. Like most of them will fail, right? So if you don't have that foundation to understand how to diversify, how to evaluate the viability of these businesses, to understand if the terms that are being offered are fair, right? I mean, it could be a great business, but if the valuation is stupid, then you're not going to make money, right?
Yeah.
And so that's the purpose of the accredited investors.
So it's not just the government trying to be mean and keep the rich people rich.
No, I don't think so. I think it is probably fair for what it was. It did keep people from investing in startups, though, and that's where now I would say there isn't much of a barrier with regulation, crowdfunding. You do not have to be an accredited investor to be able to invest, and you can at any income level you can invest some portion. Now there's a limit, right? So that's the new way that they protect you. So now if you make less than 200,000 a year, let's say, then it's going to be capped to like basically a percentage of your income or your assets, somewhere in the ballpark of 5 or 10%. There's nuances to the rule, so I don't want to get too deep into it. But just rule of thumb, between 5 to 10%, closer to 10% as you surpass about 100,000 in income or in assets, then you can.
So what are some examples of some of those places people can go if they're interested in that?
So, and I'll just disclose, I'm an investor in WeFunder. So that's a site that you can go to. But if you just look up regulation crowdfunding online, then you will find a ton of sites now that offer that service.
I know you're not a financial advisor here, so this isn't financial advice, it's just informational. But when you think about somebody who has a investment portfolio like me, for example, I have no exposure to this. I have a lot of exposure to stocks. I'm starting to get a little exposure to crypto, but this isn't an avenue that I've gone down. So how do you think, to you, how does this look in somebody's portfolio?
Yeah, I would say that the limits that are there are appropriate as well, right? So like, these are highly risky asset classes. When you invest in stocks on the stock market, as an example, if you invest in 10 good companies or 100 good companies, how many of them will be out of business in a year? Very few of them, right? They're well vetted companies, right? Whereas if you invest in 10 startups, right, most of them will fail, like at some point, right, and go to zero. And so you do not want to put the majority of, at least I would not recommend that you put the majority of your assets or your whatever you're investing, right? The pool of what you're investing, your personal portfolio.
This is like investing in penny stocks, but like 10 times as risky. Right?
Yeah, it is. It's riskier than penny stocks. Actually, I would say that's fair. This is almost the most extreme end of it. And not only that, you don't have liquidity, right? Like liquidity is a big problem. So they're trying to find new ways to solve that. But if you own shares in a very valuable, like let's say I owned I don't, but let's just say I owned a piece of Stripe, okay? And on paper, I'm not. I could be just a regular Joe. I can't sell my shares,
right,
in Stripe. Like there's no they're not, they're not publicly traded yet, and so that's a problem.
I think that's really important to and even the venture capital companies have that same equation. Like they are banking that the majority of the ones that they invest in will eventually go to zero, but what they're hoping for is one of those that they invest in will be 100x, or more, right?
That's right. But they also are realistic about the time horizon, and they know they're looking out 5 to 10 years. So you have to be willing as an investor in any of these types of investments. You're looking at a 5 to 10 year time horizon before you can see any, realize any of those gains, basically.
Yeah. So no, understand the risk. Spread that risk. You're not going to probably just bank on one, and it's going to be
No.
your shining star, right? You need to be able to evaluate a lot of opportunities and spread that around, and hope that, like I said, one of those is going to be the one that goes to the moon, I think, as the kids are saying these days. But I want to circle again back to your point about the liquidity thing, because I think that people need to understand that until your company goes public and has that exit, it's very hard for you to make that money back. You might be able to find somebody inside who already owns shares who can sell. You can sell more to. There's certain times when you can do kind of a private market, but it's going to be very difficult, right?
It's challenging, right? I would say most people aren't going to be able to get that done, even with those other tools that exist out there. It's just not common. If it's not, some official, recapitalization that the company is doing, if they're not being acquired, and if they're not going public, I mean, it's really hard to be able to
those shares. Again, for the beginners getting into this, they're not on a public exchange. You can't just say, okay, it was $30 yesterday and it's gone up to 35. I'm going to sell. There's no avenue to do that. So that's where the exits come in that we were talking about earlier, that when you buy into these rounds, they're eventually looking for one of those exit routes to get liquidity. Hopefully that makes sense to everybody.
Yeah.
Okay. So I have the option to join one of these if I'm not a kind of a high net worth investor.
Mm-hmm.
I don't have $1 million in the bank. I don't have the salary requirements to be an angel investor. I can go down the route of using some of these crowdfunding sites and get a little bit of a piece of it. But let's say I do. I've done well for myself. I've got that higher salary, or I've banked away a couple million in investments over the years. And I want to be an angel investor. How do I go about being accredited to begin with?
Yeah, I will say one thing about what you said. You do not need millions of dollars to get into angel investing, right? But there's some prerequisites, right? You're going to want to have some level of experience with investing in startups, whether that's crowdfunding, whether that's raising money as a founder of a startup. You're going to need to spend some minimum amount of time in that in that area to build up your knowledge base, so you know how to properly evaluate. But you don't have to be a millionaire to be an angel investor. An accredited investor is, like we said, someone who makes $200,000 for at least 2 years. That's a pretty high bar. But $300,000 with a spouse, that's not quite as high, right? If you've got two high income, maybe you're living in a higher income state, right? Like that's like it's achievable in midlife without necessarily being extremely wealthy. And so if you are by the definition an accredited investor, I believe that you can participate in angel investing if you meet some of those other prerequisites, and there's a way to do it, and that's by spreading out those investments, right? So as you said, you don't want to bank everything on one investment. I mean, you will absolutely fail. High probability you will fail if you just invest in one thing and then hope that thing pays off. But if you have the ability to set aside $25,000 a year on top of whatever you're putting away for your retirement, right? So you're going to want to do that first. But if still you have enough discretionary income left over, and you can do like $25,000, which is kind of like the typical, is the most common sort of investment that I've seen from angel investors, then you can participate in one startup investment every year. And after 10 years of doing that, you'll have yourself a nice portfolio of startups, right? And so that is the way that I would recommend doing it. if you're in that situation. You're going to need to join up with some of these investor groups, because the biggest problem with angel investors have is deal flow, right? It's actually a lot of work to put these deals together. There's a lot of no deal is the same. You've got to, there's terms to go back and forth on. And they're always, different in how they're structured. There's, a lot of other investors that need to, you got to corral all of the different investors that have like different agendas and get them all to, wire their money on the same day. And then you got to find all these opportunities, like where they're, I mean, I know there's like Angel List, but the problem with that is some of those sites is you really have no idea. I mean, it could just be a scam artist. I mean, you really don't know who those people are. So you sort of need to be involved in an angel investor network of some kind, or I think, syndicate is another one, is another term for it. But yeah, you need to be involved in some of these is angel investor groups. And of course, the first question they'll ask is, are you an accredited investor?
Right. So how do you, so for the audience who says, okay, that's me, we actually did get a live comment that is saying, saying, I disagree. I think you do have to be a millionaire. And to be fair to this commenter, most likely you are, right? If you're making that much money a year, and you've been doing it for a few years, you probably are a millionaire, right? I mean, you don't have to be, but you probably are. So it's a fair point. But let's say that's you. You built out a good nest egg. You have a good salary, and you say, okay, look, I can scrape together, $20,000 or $25,000 a year. I on top of my investments, I can do that. I'm interested in diversifying my portfolio and trying to find that next Facebook that I can potentially be a part of and make bank, right? So you want to do that. How do you first even start to become an accredited investor?
Well, there's no official process to being an accredited investor, right? So as long as you meet that criteria that we talked about, and one of those is having a million in net worth. So by definition, I guess you are a millionaire if you have $1 million in net worth. So that's fair. But also the income requirement is fine. So maybe you just got into, maybe it's only been a couple of years and you just recently have been eligible. So you may not have, that money banked away, but you're making that income. That's it. I mean, it's sort of like, it's, I don't know if you've seen the Office episode where Michael Scott declares bankruptcy. Sort of like, I declare I'm an investor, right? There's
not a registration process. You basically just
no. Yeah, they may ask for your tax returns or something to validate that. Whatever the angel group is. Most of the angel groups that I've seen, they just ask that you are.
Do you meet this requirement? Check. Okay. So what is the best way to find one of those angel groups?
That again, I'm a newbie angel investor, so I sort of already ended up building up a network. But I would say, do some research. They're regionally based in many cases. There are some national level, groups. I know Jason Calacanis has one that's, I think he's like the OG angel investor. He also runs a podcast. So from a resourcing standpoint, if you guys want to learn more about it, you can check out his podcast. Yeah. Mm-hmm. And I think it's called Angels or something like that. Just go just Google online for the ones in your area. If you have a financial advisor, they might know. I would ask around in your network as well. So I wouldn't just rely on a Google search result. Is basically what I'm saying.
And how does that usually work then? If you do find a group to link up with, do they just have like a menu of opportunities and you're like, I want to be part of this one and this one and this one, or how does that go down?
Yeah. So you sign up, they're like, okay, you're an accredited investor, you get on our mailing list. And then, there's different ways that they do it, but More of them are going more of a, asynchronous style, if you will, where they're just sending out like, hey, they'll send out an email and they'll say, hey, we've got this opportunity. Here's the pitch deck. If you're interested, we're just going to, have a live pitch of this, and then there'll be opportunity for some questions. And then and then if you like it, you tell them that you're going to commit to, putting money into the deal. They need that information because what someone's going to be the lead investor, they call it, right? I never knew that there was generally a lead investor, but there's generally a lead investor in the round, and that person needs that information to be able to negotiate on your behalf, right? Okay. So it's not like, I'm going to put the money up, but you don't know what the terms are yet, right? Yeah. The commitment is really more of like a pledge.
Is there usually a minimum amount? Like you said, maybe if you have $25,000 a year to do that, does that mean you're putting 25,000 into one per year? What does that mean? You're doing like 5,000 times, across 5, or how does that usually, what's the minimum?
I would say generally 25,000 is the minimum I've seen. Sometimes they'll go as low.
Investor, okay.
Yeah. If it's just a smaller group, if it's a less formal group, so like in Orlando, there's a lot of folks that we sort of built up a network, right? And so there we're a little less strict on minimums.
Yeah, and again, to be clear, you're putting this money up knowing that more than likely you're going to lose all of it. But right? I mean, essentially. But the hope is that if you do this for a few years,
you have to think about it as a portfolio, right? Yeah. You can't think of it, you do have to think of it. You just have to evaluate that single investment on its own merits. But you're investing in a portfolio. You want that portfolio to be of as many good companies, and I would expect that you invest in the companies that you think are going to go to the moon, right? Like you really shouldn't invest in like, oh, okay, I can kind of see how this will be good. And I might make a little bit of a return, but not like that's a tough investment for me, because you already know out of the gate that most of the companies in your portfolio will fail. And
so that, in contrast with what we were talking about earlier, the kind of regulated crowdfunding, the difference is that those crowdfunding routes generally aren't as big of an investment. Is that right?
Yeah, with regulation crowdfunding, you can. There's no minimum amount. You can invest.
So then, what is really the difference between the two? I mean, why not go the regulation crowdfunding route instead, where you can, with that same $25,000, you can spread it around 10 companies or whatever?
Generally, the quality of investments. So typically, and I'm not, this is definitely not a knock on companies that do crowdfunding, because I do think it is going to be a more viable route, but generally, the investments that are brought up through these different investor groups have had some more vetting to them.
So those ones that are an angel are probably a little bit further down the line with a more mature idea and maybe an actual real business.
It's been filtered a bit.
Yeah,
I think there's less filters in regulation crowdfunding.
Mm-hmm. So essentially what we're saying then is probably with that crowdfunding, you're going to expect an even higher rate of failure versus the angels, maybe have a little bit higher success, right?
I think you can. Yeah, I think you can, because I don't think, those crowdfunding sites, they do want quality investments. But they want a large number of things that you can invest in.
Yeah.
Whereas, for angel investor groups, they just want, the highest rate of return and the highest chance of success.
For these angel rounds, usually what percentage of the company is somebody giving up to the startup founder? Am I giving up 10% of my company usually on an angel round, or what do you find the ranges?
Yeah, I mean, rounds are typically 10 to 20%, unless there's something wrong. Sometimes there's like what they call down rounds, where you are raising money out of a real need for cash, right? You're about to run out of runway, and maybe your value could even be lower than what it was in the last round. And so what happens in those rounds is, even if you raise around the same amount of money, they take a lot larger percentage of your business because it's valued less.
Yeah.
But
so when you're
10 to 20%, a dilution is what you would get.
So as a founder, what you're normally doing, just so everybody who's not familiar with it knows, is you put a certain valuation on the company. You have some sort of justification of some sort of multiple that we think the company is worth $2 million. And so therefore, we're going to raise $200,000 in this angel round, which represents 10%. So everybody, whatever you put toward that investment, you're getting relatively to the valuation, that percentage of the company, right? And so what you want is for every round after that to have a bigger valuation. You want to go from a $2 million valuation to a $10 million valuation to a 20. And a down round, as you mentioned earlier, is the opposite. That's when you go for a 2 and then you're running out of money and you're desperate and you go for a 1. That's a down round. And that's a dangerous place to be, both as an investor probably and as the founder, right?
Yeah, it's not good.
Yeah, but I mean, it can occasionally work, but it's a sign that your business.
It's a bid to save the company, right? Like you're trying to save the company.
Yeah. Cool. So one thing we talked about before the show is friends and family rounds, and everybody has the cousin or the friend down the street with a startup idea, and maybe it's a little bit tempting to confuse angel investing with that, right? So let's talk about the difference with a friends and family round and maybe some of the dangers around that.
Yep, I've done that before as well. So when you invest in someone that you have a prior relationship with, there's a lot more complexity there, and so I think you have to think of it in a couple different ways. If it's okay, if you want to fund your family member just because they're your family member, your friend, just because they're your friend, you kind of have to think of it less as an investment, right? Because it's going to be a strain on your relationship if their idea doesn't succeed, and then it's sort of like hanging over your heads, right? So you sort of have to, whatever money that you're giving in that scenario has to be something that you're willing to lose. Now, that's not all that different from angel investing in the sense of, for an individual investment, and even in angel investing in general, you should not do angel investing unless you're okay, risking that money, right?
Right. The difference is, though, you're risking the money and not the relationship, right?
Right. Yeah. And so I would say there the main difference is your decision to invest or not. Like, do you want a return, or is it this just a different way of loaning money? And as they always say, when you loan money to a friend, just you got to think of it as giving it to that person.
And if the crowdfunding route was a little more risky than angel investing, probably in that friends and family stage, it's even more risky, right? So it's
right. Yeah. I mean, you have you had no opportunity to evaluate better opportunities. Like that was just the one idea that your friend presented to you, right? That's completely different than even crowdfunding, where you get this menu of options and you can be like,
it depends on your own kind of how mature you are as an investor. Like if you've had a lot of startups and you can kind of vet this yourself, then maybe you're in a position to kind of have your own Shark Tank and have your friends and family pitch to you, right? But if you haven't and you're not as comfortable with really being able to evaluate TAM and all that kind of stuff, maybe there's a little bit more safety, relative safety, in going in these angel routes where you have that vetting, you have that network of people who've been there, done that around you, right? Do you think that's a safe characterization?
Yeah, that's right. And not only that, in angel rounds, a lot of what people do is they don't make these decisions completely themselves. It's somewhat groupthink, but they'll wait for others, right? And there may be some champions in the group that maybe have more experience than some of the other investors, and they'll just kind of wait and be like, okay, is Jason going to make that investment? If he makes the investment, then I'll pile in my 25K. I'm going to wait till he makes a decision. And so a lot of times what you'll have is like no one will, like the round will be almost empty until a couple people come in, and then everyone starts jumping in because they sort of have that social proof. It's like it's safer in a way almost because other people have sort of vetted it as well.
Yeah. So if you don't mind me asking, just in your personal portfolio, like, do you have a certain percentage that you say I'm going to allocate 10% towards these types of investments?
Yeah, I personally have, I would say roughly, I'm going to put Fat Merchant to the side because that doesn't count.
Yeah.
But 10 to 20% of what I have as my investment portfolio is in startups, in angel investments.
And I got to imagine it's also kind of a rush and a lot of fun to take part in some of these early stage companies.
Yeah, if don't do it unless you're in for the story, right? That's the only reason that I think, like, if you're going to be an angel, yes, you can make money angel investing, but I do have to share this metric with you. I don't remember the report, what it's called, but they did a study, and or actually, here's an example. So there's Ron Conway. He invested in Google, right, in his angel fund, and they had a 400 times return on that, and that fund broke even. Have fun. Now you can walk around and say, yeah, I was an early investor in Google and I made whatever. I made a huge multiple on it. But if you were just if you paid into that fund, you actually didn't really make anything. So you kind of have to be in it for the story, because as a money if you just want a reliable way to make money, then go buy dollar cost average into index funds, right? Do what Warren Buffett tells you. This is not this is for because you believe in these founders. You want to be part of that story. You want to be part of the narrative, and this is exciting and something that you want to do. And you have a portion of your investment portfolio that you can set aside. Last
question, just one more kind of investment vehicle. There's also the route of doing these investments as a loan rather than straight equity, or maybe a loan where you get a little bit of a percentage on the side.
Yeah, actually, convertible debt instruments are kind of complicated. That I think that's the most common type of, I think, a loan that you're referring to. So generally, that's more on if you're dealing with like a venture capital firm. There's some flexibility in getting a return on their investment as well.
So probably not a route that a private investor can probably take.
I mean, you can, but it just makes it more complicated. Like, I think you always have the right to negotiate a deal with the person that you funded. So, for example, if I invested in my friend's company and it took off, and he wanted to raise another round. Sometimes they don't like it if there's like too many people on the cap table, they call it, which is the number of people that have invested in the company. And he'll say, look, can I just buy you out? And I'll give you like, a multiple. So you can just negotiate. And so in that sense, it's like a loan. You just kind of went a roundabout way about it, where you bought some shares, and then the other owners of the company bought your shares back from you with some interest, basically.
Okay, well, it's been a great conversation. Definitely a lot to think about. Not an investment strategy for the faint of heart by any means, but nonetheless one that could potentially have high rewards and a good story to go along with it.
Yeah, I love it. It's something I really enjoy, but you have to be ready for it.
All right, Jacques, thanks for joining me today. Everybody, thanks for jumping on the live, and we'll see you next time. Stay greedy.
Follow Greed Geek on Twitter and Facebook at Greed Geek, and follow on Twitch at Greed Geek TV.